Ladies and gentlemen, it's a great pleasure celebrating the comeback of the Global Precious Metals Roundtable, aka the Young Guns of Gold. We haven't talked for ages, and I'm really happy that we decided to do a big comeback featuring our regular members, Jen Skoyles, Jordan Eliseo, and Ronald Stoeferle. Unfortunately, Brent Johnson is not available today, but he'll be around the next time. So, Jen, Jordan, it's a great pleasure having you again. Hi, how are you guys?
Thank you for organising it.
Yeah, thanks so much, Ronnie, for putting this together, and yeah, great to be back and having a chat again.
Excellent. I mean, I had a look at our last discussion. It was, I think, summer of 2015. So let's just recap. What happened since then in your private, but also especially in your professional life?
Jen, do you want to go first?
Yeah. So since then, both private and professional, I moved to Dubai in the UAE, which has, from a professional, well, private and professional, has been really refreshing in terms of changing my work-life balance and also my outlook in terms of markets, and particularly the gold market, because I think, and this is something I'd like to touch on today, I think we often look at gold markets from a particularly Western point of view, and it's been really interesting being sat in the Middle East looking at it and being surrounded by people who are surrounded by it from that perspective. So that's the main thing that's been happening with me since, 2015. And I turned 30, so I don't know if I'm actually still allowed to be in the Young Guns of Gold, but I'm sneaking in. I think I'm still youngest, so I'm allowed here.
By far.
And Jan, is it safe to say, from rumor has it, that you've diversified your real asset portfolio with a diamond somewhere as well? Is that correct?
Actually, yes, I have. Someone decided they should invest some money in this real asset and buy me a real asset. I got engaged, and I'm now rocking a very nice sapphire and diamond engagement ring.
Fantastic. Well, congratulations.
Thank you. But to give everyone a tip who's looking at buying engagement ring out there, I would go to Dubai, because it was about 40 to 50% cheaper to buy the ring that we got in Dubai than it would have been back home.
I sense that the majority of the gold scene is thinking about committing suicide now, because, Jen, you've had such a big fan base in the gold bucks scene. Sorry, guys, it's too late.
Well, the deal's not sealed yet, so I'm open to still lots of offers.
Jordan would still be available, right?
No. I actually, my partner is in the diamond space professionally as well, which is, I'm a very lucky man to have her in my life. Although, of course, the fact that she works in diamonds poses a huge challenge when it comes to choosing the right diamond at the right time. So, Jan, I may well be calling up your partner for some advice and on how to secure a nice stone out of Dubai. That's for sure.
So, what's going on in Australia, Jordan?
Oh, look, it's been an interesting sort of 18 months, I suppose. Yeah, which is about the time since we spoke. So, probably like a lot of bullion dealers in the West, 2016 was a really extraordinary year for ABC Bullion. Not only because of the broader developments in the gold market, but as a company, we also had some fairly exciting developments. We launched a new website. We launched a new gold savings product, which was received really well by Australian investors. And as another thing, the company has now started manufacturing the Melbourne Cup, the trophy that goes to the winners of the Melbourne Cup, which is the largest and most prestigious horse race in Australia. So that's actually been a lot of fun as well, and kept the team really busy. So things have been really good down in Australia. Although, as we'll probably touch on at some point during the presentation, sort of retail gold demand, and it'll be interesting talking to Jan about the difference between, I suppose, the West and what you see in a place like Dubai. Retail gold demand in Australia has certainly slowed down a little this year, but all up, things have been really good. But it's great to be back doing this this roundtable. I hope we can make it a more regular thing going forward.
Absolutely, absolutely. So from my side, I'm still fighting demographic change. Proud father of 3 girls now. Also got married, and business-wise, yeah, we've been really busy setting up a new webpage, setting up some new funds. Of course, we continue to write the In Gold We Trust report. We've got a new webpage dedicated only to the gold report, and yeah, we are really excited because we're launching a new business in the next couple of weeks. A report about cryptocurrencies, basically translating all what's going on in the crypto space, which is sometimes very, I would say, geeky and very technical. So translating all those developments for financial market players, and we're also yeah, very happy and really look forward to launching one of the first or even the first crypto fund in Europe. So we've got a new colleague from the US, Demelza Hayes, who's doing her PhD on cryptocurrencies. She's yeah, very well known in the academia, and it's great fun working with her. And yeah, it's very exciting, and I think also on markets there's quite a lot going on, and I'd say we just jump into the discussion if that's okay for you guys. Girl.
Perfect.
Absolutely, Ronnie. Yep.
Excellent. So let's talk about gold markets and macro for a while. I think what we can see on this slide is fairly easy to understand. It's gold in various currencies, and I think Adrian Day recently said, I think that's a brilliant sentence. He said that people are expecting too much from gold at the moment, and having a look at this table, it shows that gold is actually doing pretty well. It's up 10.6% in dollar terms this year. It was up 9% last year. This year it's up in basically every currency but the euro, unfortunately for us over here. But in Aussie terms, 2.3%, it's not spectacular, but last year 10.5% and so on. Of course, in British pound terms, last year was huge because of the Brexit. So I think Adrian Day is right saying that people shouldn't expect too much, because I think the environment for gold at the moment is not that good. We're actually seeing that the Fed continues to sound hawkish, and they want to do quantitative tightening. They want to hike in December. We're seeing that stocks are soaring like crazy without any volatility. We're seeing price inflation being quite low, not really a problem. We're seeing volatility is extremely low, and we're seeing that trust in the banking system is quite high at the moment. So I totally agree with Adrian Day. I think gold is doing extremely well despite this environment that we're in. That is, yeah, as many brokers say these days, some sort of a Goldilocks scenario.
I couldn't agree with you more. Sorry, Jordan, do you want to?
No, you go, Jen. I was going to actually ask you.
Yeah, so I completely agree. And I think, just in the relatively short time I feel that we've all been involved in gold, I've been surprised at the rate at which negative news about gold outweighs positive and balanced news about gold, the rate at which that's ramped up in the last few years. And I think that's been particularly bad in the last 18 months to 2 years, as we've seen. And I know we're going to discuss this later on, sort of like think performance like the S&P 500. I think now whenever gold does anything vaguely negative, we hear about it a lot more. And like you say, the expectations about gold seem to be pumped up. And actually, when you look at a table like this, it's actually kind of quite a refreshing reminder of things aren't as bad as it feels they are when you're reading the likes of Bloomberg and Reuters. And I think this is also a nice reminder that gold is not just about the US dollar, and we're all experiencing quite different things. And yes, okay, so in the euro, it's down in the euro, but maybe that's a great opportunity for people that are buying gold in the euro, you know. So I think that just a simple chart like this is a nice reminder that whilst we might expect too much from gold, we can also be consistently surprised by it, because things aren't as bad as every day we're led to believe.
Yeah, I couldn't agree more. I think one of the challenges that gold has is that often to get any kind of exposure around sort of bullish price forecasts or the reason why you want to own gold in a portfolio, certain sort of sections of the gold community feel the need to constantly forecast these, you know, radical prices as to where gold is going to head, and it may well do that over, you know, given time, but you know, if you come out at the start of the year, I mean, gold's, you know, in Australian dollar terms, it's around $1,650 now. You know, I quite often say that I expect gold to do 8 to 10% as a sort of standard right now. But to tell people that gold's going to go up $160 an ounce for a year, it doesn't seem exciting enough. They want to hear that it's going to go to $10,000 an ounce by January 2018. And when it does, as that table points out, you know, these 8 to 10% average returns, which is a very, very reasonable return for any asset, particularly a highly liquid one with zero counterparty risk. People forget that very easily. But, you know, Ronnie, back to your point earlier and some of the other factors you pointed out, if you'd have said at the start of the year, equity markets are going to continue to hit all-time highs and there's going to be no volatility in the market at all, you would actually think that, and the Fed's going to be raising interest rates, if you hadn't looked at anything else going on in the world, you'd probably think the gold price would be down for the year. So the fact that it's actually held its own in all currencies and it's up 10% in US dollars, I think is a pretty good return. The only tailwind it's really had going for it for this year is that for the first 9 months the dollar was weak. But yeah, I think gold performance has actually been very good so far this year.
Absolutely, and you brought a chart from the World Gold Council showing that gold has outperformed the S&P 500 so far this century, returning 86% more than the market. And I think we're all pretty certain that I would say valuations in equity markets are not exactly on the cheap side. So this is a chart that I found for the first time at Jesse Felder's blog, and he brilliantly called this the everything bubble. So it's not only the housing market like in 2007, or the dot-com space like in the Nasdaq bubble 99 2000. He calls it the everything bubble. So it's stocks trading at all-time highs, bonds trading at all-time highs, and real estate, and of course the art market and so on. So as you know, I'm quite keen and I adhere to the Austrian School of Economics that basically says about inflation, first there's monetary inflation. We've seen that big time. Then there's asset price inflation. This is exactly what we're seeing on this chart. And the next stage is price inflation. So those, you know, fancy baskets that economists calculate, CPI, PCE, whatever, rising, and I think that we're already seeing the first two stages. So the third stage, price inflation, will probably happen sooner or later. And talking about this everything bubble, I thought it's quite interesting that The Economist just came out with this front page, the bull market in everything. And if you follow markets and sentiment analysis, you can see that The Economist and their covers are quite a reliable contrary indicator. I think they had the mighty dollar last year on the front page. They basically nailed the top of the dollar. Since then, it's in a quite strong bear market. So I think we should really watch out if they call the bubble once again.
Can I just come in there just on it,
Sure.
on that everything bubble? There was I don't know if either of you saw, there was a fantastic infographic, which we perhaps should have included, from Maudlin Economics, which was about this very thing, the everything bubble, and they listed 6 bubbles that they believe, you know, all need to be watched right now, and they were the crypto bubble, which was fast. I mean, I know we're going to explore this at a later date, and you've got a report coming out on it, Ronnie, but to give a sense of perspective, 4 years ago, the crypto market was worth $1.4 billion. Today, it's worth over $65 billion. And UN recognized currencies. There's only 180 currencies, whereas with cryptos, we've got over 1,000 different currencies. And then you've got the real estate bubble, which is obviously not just in the US, but you only hear about it in the US, but also Canada, and you're familiar with it, no doubt, in Sydney, Jordan, and then Stockholm.
Absolutely.
The stock market bubble, auto bubble, and the corporate credit bubble, and then the stock indexing bubble. And just looking at the, you know, no matter how much you read about markets, like, you know, we three do on a daily basis, just this infographic alone was like, wow, you know, this really is everything, and it's happening everywhere. And I mean, just the auto bubble alone was a sharp reminder of how we are returning to the days of prior to the global financial crisis. You know, 280 billion of that 1.3 trillion bubble is in subprime loans in the auto market. Which I think in itself should be a wake-up call just to, you know, retail investors who perhaps aren't following everything that's going on, you know, like as we're discussing right now.
Yeah, I think the other thing that sort of stands out when you look at a chart like this is, you know, for years, I mean, it's amazing to think it has been a decade now since the GFC hit, and then when the GFC hit, this, you know, this term debt crisis, I suppose, entered the you know, the sort of everyday financial language, and we've been talking about it for years, including the three of us, no doubt, in a way. But, you know, I sometimes think we should have relabeled it and called it an asset crisis. And when I say that, what I mean by that is that it is really, really clear that the valuation that we've put on assets around the world is completely unsustainable when you actually measure the income and the output these assets produce. And you know, that's why you see this just ridiculous ratio between the supposed value of the assets and actual income or output. So, yeah, look, it's a pretty good reason to want to own some non-financial assets, you know, non-liquids, liquid alternatives to financial assets. As to when the everything bubble starts to pop. You know, I think it could still be some time. I think there's a lot of managers now, you know, value equity managers, particularly in Australia, which is, I suppose, the area where I follow the closest. And a lot of them are sitting on cash, large parts of cash, because they're expecting this major correction in equity markets. I don't know whether we're going to see that or whether we're just going to see an extended period where markets go nowhere. And as you said before, Ronnie, price inflation starts to catch up. So I don't know that we'll get another 2007 event where equities drop 50% in the space of 12 months and everyone goes, oh, okay, now there's value in the market, it's safe to deploy cash again, or whether we get a period where markets kind of don't go anywhere for 3 or 4 years and inflation starts to catch up and eat away at the value of cash. Who knows? We'll have to wait and see how that plays out.
I think it would be naive to believe that the next crisis will be just similar to 2008, which was highly deflationary, of course. I think the next crisis might be triggered by higher inflation, by actually really inflation taking off and central banks being basically in the corner with no real way out. They would have to hike rates much faster, and this might be a trigger for the next crisis. But honestly, we're all pretty bearish for a while now. But this market just wants to go up, wants to climb this wall of worry, and we have to accept that the bull market in equities is still really, really strong. I think that the market breadth is not that bad. I think that sentiment is still not similar to 98, 99, for example. So it might have further room to rise. Jordan, risk on in debt markets. That's your slide, actually.
Yeah. I'll just make one more point on that. I think
Sure.
it's probably too easy to just in terms of what's going to happen with equity markets. Yeah, like it's too easy, I think, to assume that the unwinding of this QE trade is simple to predict or simple to play out in the sense that it'll be a major pullback in equity markets. As I say, now there's value. Now it's time to deploy cash. I don't think that I don't think that it's going to be, it'll look the same either. So I think it's going to be really interesting to see how, particularly equity managers, if you're investing in ETFs where they just blindly follow the market regardless, but it'll be really interesting to see how more value-focused equity managers try and play that, because eventually, if they find an environment where they're sitting on that much cash that's losing value, they're probably going to feel compelled to get back into the market anyway, which might just continue to push it higher. So even if there's no earnings growth. But yeah, in terms of debt markets, I mean, look, this isn't looking at yields per se on government bonds or high yield credit or anything like that. But I thought it was a really interesting slide that came from the latest BIS quarterly report. And it just looks at the quality, and if you could see my face right now, it would be with my fingers. It's in inverted commas, the quality of corporate debt and covenant standards and the like in corporate debt markets in Europe, Great Britain, and the US, and sort of how that's evolved over the last 15 years. And as you can see, covenant standards have decreased substantially. Probably the third chart within there and the fourth chart are the most interesting ones. So I think the share of zombie firms and how that has increased, it's higher in the US, but it's increased most noticeably post-GFC in Europe and Britain. And zombie firms are essentially the way the BIS were calculating it. I believe that they're companies that have been in operation for more than 10 years and whose earnings before interest and taxes don't even cover the interest bill on the debt they've borrowed or the debts they have outstanding. So it's extraordinary when you think we're at this, multi-millennial low in borrowing rates. It's never been easier for listed corporates to access cheap debt. And yet this ratio, if you want to call it that, is heading in an alarming direction. And you can also then see from a ratings distribution, which is the fourth chart, the sort of percentage of I suppose debt outstanding and its rating via either A, double B, B, triple B, and below. And you can see in all cases, again, particularly in Britain and in Europe, the sort of share of debt outstanding that's been issued to A-rated borrowers and above it's fallen off a cliff since 2000, and it's actually gotten worse since 2007 as well. So I think it's just interesting to look at what's going on here, because I think, again, for the last 10 years, when the GFC hit, we all knew that we had a problem with private or household debt. It was very obvious that it had run too far. The response afterwards, or in the last 10 years, has been for governments to borrow like crazy. And so there's been a lot of warnings about government debt, particularly in developed markets. But clearly, when you look at corporate debt markets as well, there are some pretty worrying trends that have emerged over the last 10 years. So it's just one to watch. And I think it does then, it's important for equity markets because if you're going to have more and more corporates that are finding financing difficult in the years ahead, that's obviously going to have an impact on earnings and presumably valuations, the ability for these businesses to invest in operations. So you'd think that this will be a headwind for equity markets at some point, if nothing else, as well as the real economy.
Absolutely. This is another brilliant chart, actually, that you brought up. It's by Deutsche Bank, it seems, and it says that financial assets, I think they're calculating an average of stock and bond prices across developed economies are more overvalued than at any time in recent centuries. I mean, that's basically the inverse of the rate chart, of the interest rate chart. But still, I think it's a fascinating study. And it probably also shows you how vulnerable we are to rising rates, and that basically a profound rate hike cycle is basically impossible at those levels.
Yeah, I think so. I mean, it's good as well because we spend so much time focusing on the US, and everyone's aware with where the CAPE ratio is, and everyone knows where the US 10-year yield is, for example. But yeah, I thought this Deutsche study was interesting because it did bring together 15 developed market bond and equity market, and made an index out of it. And yeah, I mean the numbers are what they are. That's not my interpretation of it. That's literally from Deutsche Bank's mouth. I'm actually curious because I haven't paid much attention, I must admit. Jan, over in Dubai, what's the equity market in Dubai like? Because it almost collapsed after the GFC, and I think there was some major home builders and that were off like 95%. But where are sort of equities and risk assets in Dubai and in the Emirates more generally?
I don't actually, it's terrible, don't pay a huge attention to it, but generally everybody is a lot more positive about things since like you say, the financial crisis that they had there. And I think also with Dubai, well, the UAE, it's very often compared to the likes of Saudi. So in comparison to that, it's obviously performing very well. But I actually tried to find some charts and couldn't find anything that was that would demonstrate things properly. But it's certainly, property is booming out there. They're building. I mean, where we live is in quite a new area, and on all four sides of our building, there are buildings going up. The Expo 2020 is coming to Dubai in 2020, funnily enough. And I can't remember how many new hotel rooms they have to have ready by then, but it's a crazy number. So I don't know if that's the sign of I'm pretty sure it is the sign of a bubble coming in that area. But in terms of the overall equity markets, I don't have any figures to hand, but generally just talking to financing people out there, people are relatively positive compared to where things were. And I think since the financial crisis, they've done a lot more to both stabilize and balance the economy, and not be so reliant on set areas, particularly we were talking about the startup scene beforehand. They're realizing they need to diversify a lot more, so it's certainly not as all money in one pot as it was in the run up to their last financial crisis.
Right, fair enough.
Yeah, that's a chart that I brought up. I think that the major opportunity costs for gold are basically equity markets. I also think that, I don't know what you think about that, but I think that the whole crypto space and all those ICOs, they're definitely kind of stealing the show from gold in terms of media, in terms of interest from investors. I think all those junior mining stocks that were kind of bought as like lottery tickets. I think much of this very speculative money is going into ICOs and all that stuff now. So, but I think that in general, for the really institutional players, I think equity markets are the biggest opportunity costs for holding gold. So I always calculate a ratio between the S&P 500 and gold, and basically a falling ratio shows that the S&P is outperforming gold. And now it seems, of course, since 2011, gold was massively underperforming the S&P. But it seems now that it's kind of leveling off, that it's building a base, and gold is trading above this 50-day moving average now, and above the 200-day moving average of that ratio. So it seems perhaps that this ratio might be rolling over. So stocks going weaker and gold higher, both, I don't know. But I think that's a very, very interesting chart, and it might, as I've said, show that slowly tides are turning now in favor of gold.
And I think we're going to talk about this. Sorry, Jordan.
No, you
we're going to talk about this in a bit anyway. But I think data from the latest ETF inflows suggest that this may well be happening. Institutional investors putting more money into gold, and I think I agree. I think the opportunity cost agree on your point on the opportunity cost. I think that that's very much in the short term, and I think it depends which market we're looking at. One of the charts we've got in later on is looking at Germany and their inflows into gold in the last few years, and I think they're taking a slightly more balanced approach than perhaps we're seeing in other areas of the West.
Yeah, I think I'd make two comments on that, Ronnie, but both of which just to sort of flesh out your comment on crypto and the sort of opportunity cost in equities, which Jan's touched on as well. From a bullion dealer's perspective, we have definitely seen. In terms of the impact of the crypto space, we've seen that impact gold in a couple of ways. We've seen clients that have owned bullion or continue to own bullion, in inverted commas, diversify their currency exposure, as they would put it, by selling some of their gold and silver back to go and invest in predominantly Bitcoin and Ethereum have been the two that have mostly come up. I don't think there's been as much money come in from retail punters into the ICOs because I think that, correct me if, and Jan, you probably know more about this, or Ronnie, possibly as well, that a lot of those ICOs actually need to be funded via Ethereum or via, so you don't really use Australian dollars or US dollars to go and to go and buy these things.
There's an adoption barrier, which people aren't aware of.
Correct. So there is no doubt that we've seen some physical sales to go and purchase crypto, and as well people who have been curious about investing in gold then go, oh, actually instead I'm going to buy Bitcoin. And again, I think it was Adrian Day you were saying made the comment, Ronnie, when you go back to this expectation of gold, there are people out there that are going, well, they see Bitcoin and gold as substitutes for each other, and they then go, well, hang on, Bitcoin's going up by 87,000% or whatever the price return. So they then go, well, actually, I want to chase that. So definitely, crypto is impacted. And to your point on equities being the major opportunity cost, I mean, I've been talking about gold to investors now for with ABC for 5 years, but more broadly for about 13, and undoubtedly, I undoubtedly cannot stress enough that it is absolutely what happens with equities and gold relative to equities that most makes people want to actually act and go out and buy gold. So when you get up on a stage and talk about debt levels or the potential for inflation and all of these sort of other factors, I mean, they're all relevant as to why you would want to own gold. But when there's volatility in equity markets, that's when people actually pull the trigger and say, okay, I'm going to go and buy some gold, because they are actually feeling real pain in their portfolio, rather than just sort of worrying about this potential for higher inflation in the future. So I agree that this is probably one of, if not the most important ratios to look at and to use when talking to people about gold, because if equities start to outperform, at the end of the day, people want to see positive returns in their portfolio. So, sorry, I should say if gold starts to outperform, we're going to see more money come back into the sector.
Yeah, that's the next chart is quite similar, obviously, but more long term, and it shows commodity index, the GSCI versus the S&P 500, and it's clearly showing that commodities relative to equities are extremely low. We have only seen such a low level twice since 1971, and we are way below the long-term median, which is 4.1. So, of course, there's mean reversion in markets. That's just a given, and therefore, on a relative basis, it seems that commodities are extremely attractive and undervalued versus the stock market, and that basically confirms my view that gold is in the early stages of a new bull market. In Dow theory terms, I would say that we're in the beginning of this public participation phase, which is the longest phase. So the first stage is accumulation phase. I think we've seen that 2015, beginning of 2016, when the media was extremely negative, only contrarians were buying, and the general sentiment was really, really bad. Now it's getting a bit better. everybody is getting a bit more confident regarding gold, and I think this is a classical sign that we're at the beginning of this public participation phase. I don't know, do you have any comments? Otherwise, we'll...
I think just conscious of time, maybe we should skip through a few slides pretty quickly because we've got some other stuff. So no, I agree. Yeah.
Sure. That was actually one of the most interesting insights from the last gold report. We had a look at Bloomberg and the consensus, the forecasts for the U.S. economy, and we actually couldn't believe what we saw. We just checked the economic forecasts by those 89 economists surveyed by Bloomberg. This is like the most respected economists sitting in big banks, big institutions, all with 5 to 10 PhDs in rocket science, physics, mathematics, whatever. And the median expected growth rate in these next 3 years is between 2.2 and 2.4%. And out of those 89 economists, zero is expecting a recession 2017 to 2019. And we have seen this extreme high level of confidence in 2007. And from my point of view, where a potential recession in the US would lead to a U-turn of the Federal Reserve. And I think this is the point when gold will really pick up momentum, because now everybody believes that, okay, we are in this rate hike cycle. The Fed will continue to hike 2, 3, 4 times a year. There is quantitative tightening, but once the market finds out that the US economy is not doing so well, I think this will have a major impact on the price of gold. And actually, this is what we're seeing also on the next slide. It's another very long-term study, and it shows in the past 100 years, in 16 out of 19 rate hike cycles were followed by recessions. And from my point of view, we're in a hiking cycle, and it basically already started when Bernanke announced the tapering. I think then actually the tightening already kind of started, and that was, I think, 2014. So yeah, I mean it's going on for a while now. Yeah, sorry, Jen.
So I just wanted, it's kind of a bit left field, but on your graph, 100 out of the last 100 years, 16 out of 19 rate hike cycles followed by recessions. I don't know if you saw, there was a study done which was published on the Daily Reckoning. I didn't see it anywhere else. It was a couple of months ago. And someone looked into the last 107 years of US presidents. And for every 2-term presidency, it was once that president left the White House, within the following 12 months, a recession followed 100% of the time.
Yeah, I think Raoul Pal had this.
That's it. Yeah,
the colleague of Grant Williams. Yeah.
And I think. I just thought it was an interesting thing to cover, and I think we're now in the we've got three months left until the end of the year, so that was an interesting figure. And I think the one on your point about the economists, I read an interesting article about when the Queen of England, and also obviously Australia, went to the Bank of England. She asked one of the Bank of England economists why the global financial crisis had happened. And he just said that, they were like earthquakes or flu pandemics. They're rare and difficult to predict. Which I thought was quite telling about how they think financial crises happen. Like there's some kind of natural phenomenon, and we can only put in short-term warning signals. And it was a little bit concerning that a central bank economist was looking at a recession, a forthcoming recession in that way. I thought there were two different perspectives on an upcoming recession.
I think as well we have to be. It's a little bit like when we think about what economists are going to say or are going to put pen to paper on. Brokers are nearly always going to be positive on the stock market. At the end of the day, economists are essentially senior marketing people for the businesses they work for. And in the case of a mainstream Wall Street bank economist, what is the product that they sell? Well, they sell stability and the belief in economic growth and rising asset prices. So it is, it would be, whilst it's maybe, extreme to see 89 out of 89 forecasts being positive, you're always going to find more optimism than pessimism, or perhaps even realism in those kind of forecasts. I can remember back in, here in Australia, a couple of years ago, the cash rate was at 2.5%. And we had, the mining boom unwinding. We had capex in a cliff. There was all kinds of problems in Australia, and not one economist surveyed by Bloomberg thought that rates would go lower. So it's, I do think that, it's an interesting point to bring up, but it's no major surprise that you see that kind of, let's call it, extreme optimism in the market. It's no major surprise. But that I had not seen the comment that you made, Jan, about the two-term president scenario. So that is an interesting one to keep an eye on.
And also, what I just basically think economists just have weak stomachs, because as we know from experience, it is tough going trying to remind people about basically how bad things look right now.
Sure.
And I think, like you say, like economists are basically marketing, I don't blame them if they can get away with being positive all the time, because one of the reasons why we all started this podcast back ages ago was because we got a bit fed up with people peddling predictions about gold prices or what was happening in the economy, and we wanted sort of something that was a bit more down to earth. But it's tough going, so I don't blame them for being like that, as frustrating as it is.
Yeah, it's basically
Great.
it's all about career risk, yeah. I mean it's no wonder that those strong consensus calls are so prominent in the markets. But I think recession. I think we all agree that recession risks are much higher than discounted by financial markets at the moment. And from my point of view, a recession is something normal. It's something healthy. It's something that is for the structure of our economy is just positive because it reallocates resources. But we all know that the longer you artificially try to avoid that natural recession, the worse it will get, and therefore I think the next crisis will make the 2008-2009 recession look like a kindergarten party. But let's see. And
I think that's because these economists though peddle this myth that a recession is a bad thing. So governments, central bankers, etc., keep working flat out, sort of, band-aid after band-aid or opiate after opiate to try and make everyone still feel better, because we have this myth, because there are so few people, unlike you, Ronnie, who are saying this is not a bad thing to happen. So yeah, blame the economists.
Yeah, well, I guess it's bad/necessary, right? Like, as in, I mean, it isn't great when businesses are shutting down and people are losing jobs and that, but it's an appreciation or a realization that sometimes the cure can be worse than the disease, and that's ultimately where we are now, right? For 40 years we've been intervening like crazy, and now we end up with this just distorted Frankenstein of a financial market and economy. So. I think it's absolutely.
So it gets into the mindset of people. We believe that things are supposed to be a particular way. We believe that we're supposed to have easy access to money. We believe we can have everything we want to. That's why millennials don't save anymore. Not only can they not afford to really, but actually they don't understand. Savings just isn't really a concept to them. It just filters down and becomes kind of the the new speak and I can't remember the 1984 phrase, but the mind think or whatever it was of the populace, and so it's even harder to pull back.
Absolutely.
Agreed.
Absolutely. Next chart just basically shows the tax receipts that are going lower and lower, which shouldn't be happening if the economy would be doing so well. So I think we have to continue watching those numbers. And here's a very, very basic technical chart that I tweeted out a couple of days ago and updated now, and it shows the RSI and MACD and the price of gold, and it basically at those levels where the RSI and the MACD was bottoming out. Those were pretty good buy setups, and we're seeing the same at the moment as well. So from my point of view, the correction might be over. Hoping so. I think seasonality is pretty good. Commitment of traders report isn't that positive, but we'll see the Friday data. Yeah, so from a technical point of view, I think gold looks pretty interesting at the moment.
I think there's definitely a lot of support between sort of 1250 and 1280 as well. So I think even if the sort of high 1270s isn't the bottom, and I know we're up a few dollars overnight. I think I think gold would have to fall below 1250 to get for me to be bearish. Otherwise, I agree. I think this has actually been a really nice pullback. Apart from the sort of futures positioning, which could still be unwound a bit, I think the market looks pretty healthy. From my understanding, from my last read as well, I think the market's kind of already got a 70% implied probability of a rate hike in the US as well, even after the pretty horrible payrolls numbers last week. So yeah, I think there's you can make a case for sort of cautious optimism short term, that's for sure, with gold.
Absolutely. Let's talk about gold's role in the portfolio. Jordan, this is a slide.
I thought this is another. Yeah, I think this is another slide I thought I'd share. And I really love it when you can find info or data from a Deutsche Bank, a PIMCO, you name it, that has relevance for gold. And what this chart shows is it's basically there's two portfolios that are in this chart. One is a 60-40 portfolio, 60% S&P 500, 40% Barclays in investment grade debt. So very traditional vanilla portfolio. And then there's another portfolio which is called they labeled diversifiers, which was made up of 6 components, including tips, some commodities, and some EM exposure as well. And what it shows, whenever there's a blue line, that essentially means the diversifier portfolio outperformed, and whenever there's a gold line, or ironically, that shows that the traditional assets outperformed. And it's pretty clear, if we look at the last 15 years as a whole, you can see that for the first 10 odd years there, the diversifiers outperformed. Then there was a year where the more traditional fund outperformed, diversifiers outperformed again, and then for the 3 years between 2013 and to 15 inclusive, the traditional portfolio really outperformed big time. And what's obvious from that is that gold, if you were just doing gold versus a 60-40 portfolio, you'd have a fairly similar looking outcome. And PIMCO's perspective on this was that we're probably entering an era where diversifying assets are set to outperform, given the already record high level of I suppose output that's going towards corporates right now, in terms of corporate profitability is already at record highs, and given the sort of stretched valuations and how low yields are. So I look at a chart like that and PIMCO's take on it, and I think that's a pretty reasonable argument, or a pretty reasonable case to reinforce why you'd want to own gold in your portfolio right now.
It's also a good case just for diversification. I mean, so few people are aware about diversification. And earlier on we talked about cryptos. I think one good thing that cryptos did was it got people thinking you could have different things in your portfolio. You could take charge of your portfolio. I think what this does is it makes people, that you can look at that and go to your financial advisor and query what diversifying assets are. You can think about that you can have different things held in your portfolio. You don't have to have these so-called and ironically called traditional assets. I think it's a great snapshot that should show retail and institutional investors that there is a huge amount of value in holding different elements in a portfolio.
And
I think there's. Oh, sorry, you go, Ronnie.
Yeah, no, I think that's a slide that we're bringing up pretty often, talking to institutional players. It's by Wellington, and it's basically showing asset classes that that profit and that suffer from different inflation scenarios, and it clearly shows disinflation, so falling inflation rates, is the best environment for stocks and bonds, of course, but rising inflation is a horrible environment for bonds. That's pretty obvious, but also for stocks itself. So people often buy stocks and because they think that they're a great inflation hedge, but they're not. It just really depends on the sector. Not every sector has the pricing power. So stocks in general are not a good inflation diversifier. So what performs well in times of rising inflation? It's of course gold, silver, precious metals, equities, commodities, and energy equities. Those are the asset classes that perform best in times of rising inflation. So what we tell our investors, okay, you don't have to believe in rising inflation, but actually this is exactly what politicians and central bankers want. They want to print as much money to get higher inflation rates finally, and they already did a hell lot of printing. They didn't succeed yet, but sooner or later price inflation will really start. And if you believe that they will succeed, you should have at least some inflation protection in your portfolio, and that's in those asset classes that nobody wants at the moment: commodities, precious metals, mining equities.
I think as well, Ronnie, like there's so much pressure now on governments that to ramp up spending. So there's this argument that we've seen fiscal austerity in the last 10 years, and that's what's held back the recovery, as it were. And there's a huge amount of, in my opinion, quite justifiable criticism about the fact that the spoils of QE have almost exclusively gone to the top 1% and have only been expressed in financial markets, which is largely true. So I think there's no question that the next round of intervention that's required from central banks and or from governments directly is going to involve greater spending in the real economy, which you would expect would impact in inflation as well. I think one of the other things as well that's interesting, and this is probably more relevant for retail investors than someone buying in through a fund, because Ronnie, someone like yourself could obviously express exposure to all of these different themes and asset classes very easily. But for your average person, your average person doesn't know how to go and buy a hedge fund. They might not know really even how to get emerging market equity exposure in their portfolio. But one of the beauties of gold is that it's so simple. Anyone can go and buy an ounce of gold or a few ounces if they want to diversify their portfolio. And that kind of that simplicity and that tangibility, I see it every day with the people that we speak to. They love the fact that they can see it, touch it, hold it if they want to. Most of them will end up just leaving it with us anyway. But the simplicity of gold, particularly in more difficult times, becomes a real attraction to investors.
Simplicity is the ultimate form of sophistication. I think I don't know, I think Leonardo da Vinci once said that. Or...
Da Vinci said it. Yeah, correct.
Oh, I don't know how often he went shopping, but okay.
Who was that?
I said I don't know how often he went shopping for nice things, but okay, we'll go with that. Certainly an investment.
And that's our inflation signal that switched to rising inflation a couple of weeks ago. So we basically start accumulating mining stocks, commodities, energy equities, and it's interesting that it flipped to falling inflation in November when everybody was talking about Trump's reflation and all those fiscal stimulus programs, infrastructure, and so on. Everybody was positioning for higher inflation. So our signal is some sort of a contrarian signal, and we're really excited that we've got the inflation signal now and that we can position accordingly in our fund for rising.
How many inputs are there into the inflation signal, Ronnie, that you guys use?
1206. No, it's 5847, I think. It's a very basic model.
That's a great chart. I really like that.
No. It's for the inflation signal, we've got basically only 4 ingredients. I can tell you the weighting, but we really like the gold-silver ratio as an inflation indicator. We like mining stocks to the S&P as an inflation indicator. So all ratios. We're having a look at gold itself, which is a great inflation indicator. We're looking at monetary aggregates. And their momentum. Yeah, that's basically it. I think we're. Yeah, sure.
Sorry, I just wanted to. I think like one thing because we've talked about what's happening with danger in a lot of markets, but I think one thing inflation is clearly rising, and I think one thing we just need to briefly touch on is this looming pensions crisis, which we focus a lot on Goldcore, but is rarely covered in the mainstream. And I think is one thing I think for a lot of retail investors to pay a lot of attention to, because pensioners or those saving in a pension are really going to feel the pinch when inflation takes off. And I think it's something quite important that people need to appreciate, that this pension crisis is coming. And I can't, I had it in my notes, but I had the number that the World Economic Forum estimates for our pensions crisis, but I think it's over 300 trillion by 2050. And that's how much we're going to be short in terms of the pension crisis. And I know, Ronnie, you're doing your bit in terms of procreating. You've got 3 daughters now to try and help support our future pensioners. But it is a very, very serious issue, and it's going to be, and it's increasingly dangerous because of this rising inflation, which governments are so determined to increase and not do very much about in terms of the other side and pensioners and savers. So I just wanted to just mention that briefly.
Yeah, I mean, we could have in another session, we could have that as like the main topic if you want. I think that's something that's definitely interesting.
Sorry, so 217 trillion is the number by 2050, which is currently 327% of world GDP. Wow. But yeah, we should definitely cover it as a topic in the future.
Absolutely.
Hey, that would be excellent. Yeah.
So the last chapter, gold on the international stage. I think, Jen, you brought that up. U.S. gold coins shrink.
Jordan and I have both, I think, covered the U.S. gold coin. I think this is his chart he sent over, I think. But I covered it as well. And I think I just wanted to just look at this just from the perspective that I was talking about at the beginning, in that we always, the mainstream, look at gold from a very Western and US centric perspective. And these US gold coin sales, which have been down for the last 9 months of the year, and are at their lowest level since 2007, as you can see on the chart, have been an opportunity for the mainstream to jump on, sort of saying, investors preferring stocks, they're seeing bigger returns in the S&P 500, etc. But they are ignoring figures from the likes of the Perth Mint, which perhaps Jordan wants to talk a bit more about. And I think it's important to look at the likes of the Perth Mint, because whilst the US Mint pretty much solely sells to the US, the Perth Mint sells all over the world, to the likes of Asia and Europe as well as at home. And I think that's actually a very good reflection of where of gold coin demand and general sentiment about gold coins. And the Perth Mint have had a pretty good couple of months. So I just wanted to just bring this to our attention. I don't know if Jordan's got more to add on it, but I thought it was quite important. And also in Iran, sales of gold figures have gone up considerably since the government dropped interest rates. So they've decided to start buying gold coins instead. Investors have there. So I just wanted to just say, let's not just look at what's happening in the US. Let's look at gold demand elsewhere.
Yeah, no, I think that's a very, very relevant point. We're also particularly US centric, but definitely sort of Western investor centric in our analysis of gold and where demand is. ABC is quite lucky in the sense that, having been around for over 40 years now, we actually have a really large client base in Australia that are actually Chinese, Vietnamese, Indian, Southeast Asian background, you name it. So we are in some way, our business isn't purely based around, I guess, interacting with Western investors. So where we see some of that that flow, as it were. From our point of view, from what we're seeing in general, demand is definitely softer overall, but not from all segments of buyers. I think your points are absolutely valid, Jan. I think, and sort of moving on, I suppose a little bit, just I'm conscious of time as well, Ronnie, because what's happened in ETF space in the last few weeks, I think is quite interesting, because typically you found this has been really correlated to gold prices. So if gold price is rising, you see ETFs, seeing inflows and vice versa. But in September, we saw about 25 tons of gold come into the ETFs, nearly all of which was coming from North America, even though the price sort of fell the better part of $50. So I thought that's an interesting development. You got any particular theory as to why that happened, Ronnie?
Not really. No. I honestly, I don't follow the ETF flows too much. I think for me, they're basically a proxy for I would say institutional players, which are very much trend following. So normally as prices rise, ETF inflows happen and vice versa. But for that particular time, I don't really have an answer.
Yeah, it'd just be one to monitor, I suppose.
September was quite interesting, wasn't it, in terms of what was happening with the US and Korea. I know everyone's looking at that as a short-term thing, but that was certainly the main headline. And I know the debt ceiling crisis didn't happen in September, but that was certainly a concern in the run-up to September as well. But I wonder if September was a wee bit more of a wake-up call for American investors, really actually how far Trump was going to push things on an international stage. And, okay, fine, he might have calmed down a bit on Kim Jong-un. I always get confused between him and his dad. Kim Jong-il is no longer more, he's very ill because he's dead. So it's in Kim Jong-un. Sorry?
I was going to say, I prefer the Kim that did Gangnam Style. That's a really good point, Jan. Sorry for interrupting.
So I think there's certainly that perspective, and it'll be interesting to see what happens over the next couple of months, because okay, fine, maybe North Korea's quieting down a bit, but now we're also seeing problems with Turkey as well, and obviously Iran. There's been a huge amount of saber rattling there, so I wonder if it's I think the first half of the year was really dominated by Trump and his domestic policies, and the second half, certainly the last quarter, we've been really very focused on his relations elsewhere. And I think it's been quite scary for people. So a part of me wonders if maybe that's got something to do with these figures.
I think it's interesting that the correlation between all those, how do you say, saber rattling, and Trump's approval
Star
rate.
Wars term.
So he got much more popular the last couple of weeks, and he already showed when he did this airstrike in Syria, it seemed to work, and now with Iran and also especially North Korea, it seems that his numbers are up significantly.
But is faith in Trump a proxy for a reduction in uncertainty in terms of what's going to happen? Just because we have faith in somebody, does that mean that we therefore have faith that things are going to A, work out in our favor, or B, that they're going to be short-lived or something? You're still taking a punt that war may or may not happen.
Of course.
Yeah.
Of course. Interesting thing was that the very high correlation between the approval ratings of Donald Trump and the US dollar. I recently tweeted that out. I thought that was a fascinating chart.
In terms of as his approval rating goes up, so does the dollar.
Yeah.
That is an interesting one to keep an eye on. Look, I think we're going to have a lot to discuss next time we catch up as well. Markets are certainly evolving fairly quickly.
Well, the last one, basically, Jan, you brought up the Russian gold reserves.
Yeah, I just thought. The World Gold Council made a point of featuring this in their latest report, and Jim Rickards, who we've had on, I think we've had on before. I know we tried to have him on before and we couldn't arrange it. He's often talking about Russia's demand for gold and their reasons behind it. And I thought it was particularly interesting given, they are now the largest official purchaser of gold. They're also the third largest producer. And I don't think we've yet realised their full international potential in terms of what they could do with gold, particularly in the deals that they're making with the likes of China to try and circumvent the dollar. And, we have to consider that for years, the US has always had the threat of SWIFT and dollar use, and also, of course, the IMF veto. And as we see countries such as Russia and China position themselves away from the dollar with the likes of gold, I think it's worth keeping an eye on. What's particularly interesting about Russia at the moment, looking at it from someone who's sat in the Middle East, is that Putin is positioning himself as a kingmaker in the Middle East. And of course, we know how the Middle East feels about gold. We also know their thoughts on America. So I think this is kind of put in as a sort of one to watch. But on the flip side, private investment is actually very low in Russia. They just bought only 4 tons in 2016, which is significantly low compared to the likes of the US and Germany and others that we often talk about. I just wanted to just bring this up because we often talk about China in terms of competition to America in terms of gold demand, but the PBAC only bought 80 tons last year compared to Russia's 200 tons. Yeah. So it's worth keeping an eye on.
Agreed.
Absolutely. And we're already talking for more than an hour now. It seems over here in Austria it's 11. It's 10 in London where Jen is at the moment, and in Sydney it's what, 8?
8 a.m.
8 a.m.
Yep.
So right. Just a brief summary. We said that gold is doing pretty well, but nobody really cares about it. So people expect a bit too much from gold. It's still up 10.6% since the beginning of the year. The normalization of the monetary policy in the US is crucial for gold. And if there's going to be a U-turn, what I basically expect, this is the time when gold really becomes interesting. We like mining stocks at the moment, also due to our inflation signal. And I think something that really nobody cares about at the moment is silver, and especially silver mining stocks. But as soon as gold picks up momentum, I think that silver should outperform gold again. So that's it from my part. What's your final comment?
Yeah, I think probably the most interesting comment, the Adrian comment that you mentioned, Ronnie, I think is probably the perfect one to illustrate where gold is now. Is that there is too much of an expectation that it is going to skyrocket back to $2,000 and beyond. Gold is doing its job. The performance this year across a range of currencies is more than reasonable, and investors in it should be very comfortable with the reasons why they own it and continue to do so.
Yeah, I agree. I agree with that completely. I think we need to continue to look at gold away from the very Western perspective and short-term focus that we're so often sort of caught up in doing so. People are very down about gold this year, which, we look at that very first table we looked at, and there's really no need to be. And yes, we might be experiencing a drawdown in gold by some measures, but we've seen it before, and we've seen it come back stronger. So I think, we shouldn't expect too much, and we should continue to look at it in the wider perspective in relation to all these charts that we've discussed this time.
Excellent. I think that was a really, really great comeback of our roundtable. I greatly enjoyed it. I'm really happy that we came up with the idea doing the show again. We're going to do it on a more regular basis going forward. I think there's plenty of interesting topics to discuss. A big thank you to Jan and Jordan. Wishing you a good night, Jan, and a good day, Jordan. And to all our viewers and listeners, thank you very much. Leave us your comments about the format, about potential guests and topics to discuss. And we all hope that you enjoyed it. Thank you very much. Take care.